if you have an IRA or if you are looking for amazing tax benefits. We are going to break everything down from you from start to finish. We've got some fun trivia. We're going to be hopefully, Nate, can I give away a book? I want to give away a book.
Do it, man. Let's do
All
it.
right, we're going to give away some prizes. The whole point of this call is to help you be great investors. If you're new to Home Invest, I think most of you guys have been around us for at least a little bit. We practice the Matthew 25 principle, helping you be great stewards of what God has blessed us with. And that's what we're going to be jumping into today. Nate, I'm going to bring you up here. You have some really cool stuff to start the call with. We're going to kind of go through trivia. So a lot of people think they know what IRAs are, how to do self-directed. Ralph, good to see you, and you're not zooming. I love it. Um, so a member of our team, I won't mention that person by name, was talking right before this call, and she said, I've been in real estate for 25 years. I've invested in everything in the world when it comes to real estate, but I don't have a self-directed IRA. I didn't even know what that was. So Nate, what is a self-directed IRA and how can people use it?
Yeah, most people think that they have a self-directed IRA, but they actually don't. A lot of people have an IRA or a 401k, but it's not self-directed. And the reason that I can say that so confidently is because back in 2006, I had an IRA that I thought was self-directed. Target, where I used to work a long time ago, Target Corporation, they let me put away money into it and they matched. And then I got to what they called self direct. I got to choose between one of three different buckets to put it in. And that was their identification of self direction. But that's not what actual self directing is. Imagine being able to invest into a company directly, not buying stocks, but like actual like private offerings. Imagine being able to buy a piece of real estate with your retirement account directly where you or your retirement account owns that piece of real estate. Imagine buying land with your IRA directly or buying crypto or gold. That's the self-directing that we're going to talk about today. There's a lot more benefits when you can control it directly through what we call self-directed IRA. So what is self-directed? It literally means that you have full control. You can point the funds exactly where you want them, when you want them.
Okay, so are there some limits around this? You have a trivia slide. We're going to go through and I'm going to be watching the chats. I want to see some people engage. We're going to be giving away some books based on answers and engagement. So, all right, trivia. How many people self-direct?
What do you guys think? How many people or what percentage of the population do you think self-directs right now, has an actual self-directed, not like what the corporations tell you self-directed, but an actual real life self-directed IRA or 401k? What percent of the population do you think it is?
Chris says less than five. And just so you guys know, we're playing Price is Right rules. So you can go up to the number, but not over. Chris says under 5%. Linda says 10%. iPhone MN blah, blah, blah says 2%. Paige says 10%. Anyone else got some guesses in there? Ralph, you're at home. You better guess. Five. Mark says five. Mark,
Yeah.
Mark took the exact number.
Yeah.
Ralph, I'm calling you out, man. You got a chance to win a book.
So who do you want to give the prize to, Steve?
Well, I don't know the number. What's the number, Nate?
So it depends on the data source, but it's 3 to 5% of the American population has an actual self-directed IRA. 3 to 5%.
I'm gonna give that to iPhone MN, blah blah blah. We will get you a link and we will give you a book. We have either a tax book available for you. Nate, I don't know if you have this handy since we kind of did this. Um, my book is back there on the shelf. Uh, we have a tax book, which is phenomenal. I think Nate's actually grabbing it. I know it's there on his shelf somewhere. My book is
Tax free wealth. I got it right
oh,
here.
there
So
you go.
for
You
those
got it.
that you want the secrets, the ninja secrets of not paying taxes, written by CPA Tom Wheelwright. This is an excellent book. A must read during this time of year.
Okay, let's give that book away. My book is personal development. Your book is going to actually put money in people's accounts. So let's go with that one. All right, next question up. How much is the total asset value of all IRAs? Ooh, this is a big one.
Who's got this one? How much money is sitting in IRAs right now? What do you think it is inside the
Sue
United
jumped the
States?
gun.
I didn't even see your questions, and that's what I was looking up.
Are you over there Google searching? You got your
I
AI bot
was.
next to you?
I cheated.
Sue and Chris, man, we're gonna have to kick you guys out. Mark,
I copied Sue.
got it as well, though.
I copied Sue. Full disclosure.
Mark is jamming too. Mark is getting right in the pocket on all these.
That's good. Okay. What's the contribution limit? This is an interesting one. We're going to talk about this because if you see the two questions below, Mitt Romney got 100 million in, and Peter Thiel, man, he did it right. He got 5 billion in his Roth, which is tax free. Um, how did so? What is the contribution limit? Let's start with that one. Anyone care to guess what the contribution limit is?
Who knows what that contribution limit is? This is the maximum you can legally add to your IRA this year, this calendar year. You got a few months left to do it. They let you do it now all the way through the spring. Mark 17,000. Philip says 400 a month.
Ooh, 400 a month. I like the monthly thought.
So the answer is $7,000. 7,000 if you're under 50. If you're over 50, you can put $8,000 in. So now let's parlay this into the next question. How did Mitt Romney, knowing you can only put in $7,000, and it's never been more than that, it's always been less, knowing you can only put in $7,000, how did Mitt Romney, who's not a million years old, how did he get 100 million into his IRA? How did he get 100 million into his IRA?
Chris says did he purchase stocks? He would have had to pick the right stock or buy Bitcoin at like 500 bucks.
Similar question. How did Peter Thiel get 5 billion into his? Knowing you can't contribute millions or billions, it's 7,000 per year. And it used to be less than that. They just bumped it up not that long back. So how on earth did they do that? And that's really the fundamental crux of what we're going to talk about today, why we're talking about this today. Only 3 to 5% of Americans have a real self-directed IRA to begin with. And then even of that, a lot of people don't do contributions to it. They don't understand how to actually move it. But the real big players like Mitt Romney, Peter Thiel, they understand the benefits of it. They understand that throwing your money just in the stock market for all of your life, it can have some rewards, but it might not necessarily get you to 100 million or 5 billion. So what did Mitt Romney do? Mitt Romney bought stock, 100%. He bought stock in companies. His expertise was buying companies that he could restructure or break up and sell off assets and things like that. And he used his IRA for a lot of those purchases. And so when he would sell it and quadruple his money or 10x his money, his IRA would grow dramatically. Peter, I don't know all of his secrets. I didn't get to research what he did to make his IRA blow up to 5 billion, but I imagine it was similar.
So I know the answer to that one.
Please.
I'm pretty sure that he purchased PayPal stock in the beginning. And then when they sold it, it like 1000x'd. That was where it started, and then he put it in a couple other, but it was the same thing. Buy something that appreciates at 100 or more x, big multiple, tax free, and then repeat and repeat. So Peter Thiel has been at it for 30-ish years, 35 years. I actually read the case study on that one somewhere online. You can look that up. But it's pretty interesting when you see how these guys thought about it. It's not a 1-year play or a 5-year play. It's a long-term play with how do you get it to appreciate at multiples? Tax-free.
And that's the crux of the conversation today. So rather than just being stuck in what my former employer used to make me choose between three buckets. We have choice when we do self-direction. So, Steve, you tell me how you want to do this. We can pull Sue in anytime that you're ready, but we want to go through and actually talk about self-directing an IRA.
So I'm going to pull Sue up, and Nate and I are going to take turns. Sue, even though she cheated on our questions earlier, she is one of the most knowledgeable people when it comes to this. She's helped at this point probably over 100 investors get this set up. We bring her on because she's helped so many people through this. Plus, she's done the process for herself. So we're just going to kind of walk through this from start to finish. It is much, much simpler than you think. So many people get freaked out when they think about, you know, oh, it's a financial instrument. There's going to be all these laws and regulations. It's pretty simple. So we're going to walk through what the process looks like start to finish. We'll answer any questions. If you have questions, put them in the chat. We'll take time to answer them. When our goal is over the next 15 to 20 minutes to have a clear process outlined for you so that you know what your next steps are. Because if you take the time to set this up and you get this done, you can get it done before the end of the year and start putting money in. It is tax-free growth. And when you look at retirement 15, 20, 30 years from now, or maybe shorter, you want to have this set up. And the best time to plant a tree, when's the best time to plant a tree, Nate?
10 years ago.
I think Chris Lavin would say 20, but 10 is a good one. The second best time is today. So we want you to be able to leave with that. So Sue, right off the bat, can anybody set one of these up? Is it
A self-directed IRA, yes. A solo 401k, no.
okay? So what's the difference? Let's start with what the difference is, and then let's stay on the IRA for a minute.
The IRA, anybody could set up a self-directed IRA. You know, you have your limitations as to how much you could invest in it. And you do have to have a custodian. So you usually have custodial fees that have to be paid with the self-directed IRA.
Okay, so is an IRA the same as a Roth? Or because we saw, can a Roth be an IRA? Talk to me about
There
what
can
all.
be a Roth IRA. Roth is after taxes. You've already paid taxes on the money. Whereas with the IRA, you have not paid taxes on that money yet.
Okay. And these are funded through your work. Can you personally fund them? Let's walk through what funding them looks like.
These are personally funded, unless you have some special setup with your employer, but they're usually self-funded.
Okay. So what is the process then for setting them up? And Nate, if you think of anything that I'm missing, feel free to jump in.
Well, you would call a custodian, you know, like when I knew I was going to retire from my corporate job, I called a lot of them, you know, so I called them, interviewed them, found out, you know, a little bit about each of them, but you just call one, set it up. You usually have to pay a fee to set it up and, you know, and then you fund it.
Sue,
Okay.
is it,
So, go ahead.
Is it safe to say, Sue, that you know the best custodians in the industry, the ones with the most control for you, protection, and most reasonable on fees? Do you feel like you got a pretty good handle on that?
I'm really happy with my custodian, and they do both. Broad Financial, they have a sister company, which is Madison Trust. The same owner set up both of them, you know, so if you call and talk to like my guy, Jason, he would direct you to whichever best works for your situation.
So I have interviewed a lot of custodian owners. We've bumped into them for years in this business, and Sue showed me hers, and I switched. I used to use Pensco, which is out of San Francisco, one of the bigger ones, and Sue got me to switch based on what she showed me, and I've moved over to the one that Sue's describing as well. So it does make a big difference because fees can add up. Half of the reason that you'd want to consider moving from a traditional IRA with your employer over to a self-directed IRA is to eliminate all the middleman fees. And the one that Sue chose, they're really good. They keep their fees very reasonable each year.
Yeah, with the self-directed accounts, they still usually have a custodian, the self-directed IRA. With the solo 401k, which is a little bit bigger, I pay $149 a year, and that's it.
And what, like, the custodian's job is to do what? Why do you have to have a custodian?
Well, I don't know why you have to have one with the self-directed IRA, but you would, like, if you were just saying doing a syndication or buying a house, you have to show them the documents, they review it, they approve it. So they have a little bit, and maybe it's good because then they could just guide you if they think you're making the wrong investment. But then you send them all the information, they approve it, you have to fill out a couple different forms, and then they will wire in your money. They control your money with the self-directed IRA. With the solo 401k, I have a checkbook. So.
Are
Yes.
there, go ahead, Nate.
To answer your question further, it's an IRS requirement. Mark put that in the chat. He's spot on. I imagine, I don't know all the whys behind it, but I imagine that the IRS, when this law was passed, I imagine that they wanted to make sure that there was no fraud going on. Because let's face it, it'd be tempting for somebody to see their big fat retirement account and just dip into the piggy bank whenever they wanted. But at least by having a custodian in the middle, there's fraud prevention that happens there. So for all of us that are honest people, like, their custodian's a good thing. Like, you want that. You want a second set of eyeballs looking at each transaction to verify that it qualifies as a transaction for your IRA.
Yeah, that is actually I talked to our friend Aaron Adams about that specifically, and he said the reason that it is there is because the IRS wants to know that you're not committing some kind of tax fraud, and the custodian's job is to make sure that you are not investing in something that is shady. By them signing off on it, you're getting third-party approval that is objective, and they're taught to do it. That's what you're paying the fee for. It's exactly what you said, Nate, to stop people from being like, oh, I've got, $1 million in my retirement account, I'm going to go buy a car with it. It's figuring out and having that third party oversight. That's exactly what it is. There's a question: does this work for self-employed individuals? This is a great question. Solo 401k and the IRA. Sue, I saw your eyes get really big.
Oh, I mean, I love my solo 401k, so like if you're retiring from a job, you have your traditional 401k with your employer. When you leave, you can roll that directly into the solo 401k and immediately use that money I've done private money lending, I've purchased and sold properties. Now I do the multifamily syndications with my retirement account, and I double that money every 5 years. So there's that part about it. I'm controlling my retirement dollars. I don't freak out anytime the stock market goes down and I lose hundreds of thousands of dollars. I don't lose money with my retirement account. And then, since I'm a business, I'm self-employed, I'm a contractor with Nate, but I get paid for raising capital, selling houses, finding private money, so when I get paid, and if I have a really good year, I could contribute up to $73,500 a year into my solo 401k, not pay taxes on it now, and immediately invest it in what I want to. So I love my retirement. And like I said, I pay $149 a year. The Broad Financial will go ahead and update the IRS each year saying that I'm in good standing. And then that $149 pays for that. And then I have to do a Form 5550 in July, and that also pays for that. So.
Sue, if we get into, sometimes people, they hear about prohibited transactions, things they can do, things they can't do. Could we dive into some of what you can do first, and then let's talk about prohibited transactions, what we can't do next? Is that fair? Okay.
I'll try. I'm not Not
Just
that
so you
much
guys
of
know,
an
we do have
expert.
2 questions in the chat as well. So
Oh,
let's
cool.
go through this and then we'll come back to the questions in the chat. I see you, Mark, and I see you, Kay.
Cool. So what can you do? So on the screen right now, this is a side by side of a regular IRA versus self-directed. The reason that we're pointing so hard towards self-directed is because you can do more with it. With regular IRAs, you're stuck to whatever especially if it was an employer generated IRA, or even if it was your own, depending on who is the person or group that helped you set it up, they have limited things that you can invest in. Whatever they decide you get to invest in is what you can invest in. With a self-directed IRA, you can literally put it into a piece of real estate, syndication deals, gold, crypto. You can become a business owner in a small business by buying shares directly, kind of like what Mitt Romney did to make his IRA turn into 100 million. You can buy futures, you can buy land, you can be a private lender. You yourself can be the bank writing a check and having a mortgage or a deed of trust and collecting interest every single month. So there's a lot more. Sue, what would be a prohibited transaction? What can't you do with a self-directed IRA or 401k?
You cannot buy a property for your parents or your children or any family member. You can't personally benefit from it. You can't buy like a retirement home for you or, or a vacation home for you to use. You could buy a property and rent it out as a vacation rental, but you could only go there twice a year, once to open it up and once to close it. You can't buy baseball cards or, there's a list of things. I mean, you could buy into bourbon or, there's lots of things you can, but there's a handful of things that you can't. But like even with a flip, just say you buy a flip property, you're personally not supposed to do any of the work. You could hire contractors, you could pick out the materials that you use, but you're not supposed to personally do the work. And anything that property makes has to go back into the IRA. You cannot use that and pay yourself or anything. So it's still a retirement fund.
Cool. Steve, you want to go ahead and hit our questions?
Yeah. So Mark asks, how difficult is it to transfer a self-directed IRA from a brokerage firm that invests in equities into self-directed IRA account that invests in real estate? And Mark, although we are going to answer that question directly, this goes for anyone that wants to transfer an account in. Sue, I know we can talk about Broad Financial. That's the easiest one.
Yeah, it's not difficult to roll over from one retirement account to another retirement account. You would first talk to the new custodian, have them set it up, and then they usually have like a form that your old custodian would sign, to roll over the funds. The hardest part is usually to have the old custodian let go of your money because they don't want to let go of your money. So they'll talk to you and say it's the wrong move. It's, you shouldn't do this, blah, 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 blah. But that's probably the hardest part.
Yeah, I actually want to comment on that. I know Nate, you do as well. Like I dealt with this year, and they tried to talk me out of it. They made me jump through some hoops. Oh, you've got to get on this call. Oh, you've got to get on a call with this other person because you have to realize why they're doing this. They will say it is to quote protect you or make sure you're doing the right thing, but at the end of the day, they get paid for having your account. That's why they're making money, and that's how they're making money, and that's why they're fighting to not lose your account. It has nothing to do with what is in your best interest. Nate?
Northwestern Mutual just did it to my wife. My wife's moving her IRA right now, and Northwestern Mutual wanted to be on the phone with her, and we sent an email just saying, hey, please let us know what account numbers, and we attached the transfer form to show them where we were transferring it. And then right away, they're like, oh, our policy is we have to talk to you. And I went through this with them a year ago when I did mine, and it was really just to try to talk me out of a phone call. But that's okay. I understand. I get it. It's because they get paid for assets under management. So if they lose those assets under management, they don't make their money. So expect that. But outside of that, it's super simple. So the root of your question, Mark, it's one piece of paper So I just went through it with the company that Sue's describing. I literally filled out a form online. It's probably about 10 or 15 questions. I had to include the account number, the routing number, all that stuff where the money was coming from. And then I had to sign an authorization at the bottom. From there, the company called me, the company I was rolling it over to voice verify and ensure that I was, in fact, the person that submitted everything. And then they generated a form that I needed to be signed by my previous custodian. And so transferring it was really, really easy, except for the phone call with my previous custodian. That took a little bit of time.
I've had two situations. One took 3 months to roll over, and I don't even know who it was. It was a New York company. And then the other one was my sister's 403B. You know, she was a retired teacher, and that took a long time. And they insisted on paperwork, not doing anything online. So they would send a document, she would sign it, send it back in, they'd send her something else. And that one probably took a good 8 weeks. So
Most of them are like 3 weeks.
most of them are quicker, yeah. But I think that's the biggest hurdle.
Yeah. It is very simple. And if you go, one of the things I like about Broad is they manage it every step of the way. They'll email, they'll be there. They were for when we did ours. They made it very simple and they took great care of us.
Mm-hmm. Yeah, if anybody wants a personal introduction, I love doing that. I love introducing you to Jason. So
I use Broad as well for the more complicated self-directed 401k, and it's the best thing I ever did. Sue introduced me to Broad. They made my life so easy. It took a week, and it was game, set, match. Went to the bank, set it up. As a self-employed person, it was the best thing that we could have done for our company, for ourselves. It's unbelievable. And I did that 2 years ago. And by the way, today, my total value of my 401k is 6 times the original amount.
Oh,
it goes fast.
who doesn't like that? Man. Jennifer says ditto for me. Sue connected me. iPhone, if you want their contact info, Sue just dropped a link in the chat. Book a call with Sue. She'll get you all connected and hooked up, taken care of. All right. Next question that was in there. If an LLC owns an SD IRA, self-directed IRA, do you have to submit the FinCEN info? Yeah.
Yeah, you do, but there's something that came out yesterday that the Supreme Court of Texas has kind of put a hold on that. So if you haven't filed your FinCEN information on your LLC, you don't have to right now.
All right. Those were the two questions that were in there. We went through self-directed IRAs. We went through 401ks. The 401k, for if you are self-employed, you have to be self-employed and you cannot have any employees. You have to be truly self-employed. It is a great way to build your retirement. Definitely look into that. You can Google it. You can find all kinds of information there, but we're here to answer your questions as well. So you can book a call with myself or Sue. We're happy to chat about that. Any other questions over either of these two?
I think the one negative about investing with the retirement account is you don't get the accelerated depreciation on a multifamily, you know, because you don't get to use that. But otherwise, it's been a great asset for me.
Cool. All right, Nate, do we want to move into taxes? So
Yeah,
it is that time of year.
Let's do it. Let's talk tax.
Sue, thank you very much.
Bye, folks.
All right.
Okay, so tax time specifically for us as real estate investors, this is like the best time of year. It's like Christmas for me already. We get the busiest now until about December 20th or so because people are plotting their moves. You only have roughly 20 days left where you can actually save yourself from writing a check to the IRS. And yes, what I said is true. You don't have to write yourself a check to the IRS. You can actually instead make strategic moves right now. And I'm not talking about buying an SUV. I'm not talking about buying an airplane or anything like that. I'm talking about buying an investment property and taking some of the tax benefits from it and applying it to this year's taxable income. So if you are in a position where you think you're going to have to pay the IRS money, pay attention to what we're talking about during this section. This section could be the most important section you hear for the rest of the year. So we had a chance to work with a client who he had his money managed by one of the really big name family offices. And this family office required a $50 million net worth to even get in the door. And this individual, he said, hey, I'll let you manage some of my money, but it has to be done in accordance to what my family office says. So I got a chance to go down and meet with this family office. I stand up in this little room. I present to them. I show them what we're doing. I teach them everything that we're doing in real estate. And when I get done, the CPA spends about the next 30 minutes really just kind of picking me apart, saying, well, hey, what about this? Have you thought about that? Can you change this? And there were 4 main things he wanted changed. And he said, Nate, if you can change these 4 things, we could probably bring a lot of money to your guys' deals. And I said, please tell me, what are the 4 things? And so those 4 things, we wrote this book. It's called The Sarah Method. If you guys would like a copy of this book, we can give a copy of this to you today. It's a beautiful little book, and it goes through what that family office taught us. From a high level right now, though, we want to go through it because there's some tools that you should put in your tool belt right now to not have to pay the IRS so much money. So I'm going to skip, just for time's sake, I'm going to skip to the second one, which is accelerated depreciation. The way that this works is as follows. We have multifamily real estate that we buy. We hire people to go out and run these specialized reports on them called cost segregation studies. And what that is it's basically a glorified engineer that understands tax code that goes on site to the property and writes a report saying, hey, IRS, I think that these fine individuals, they're eligible to get XYZ dollars in tax benefits right now. And the reason that we do that is because if you don't, what happens is that the government kind of has you go to a default mode. They say, well, hey, how much did you purchase it for? How much is the land worth? We have to subtract the land out. And then we're just going to take that big number and divide it by 27.5. And then they let you have this long form depreciation, really, really slow tax benefits is what that means. Instead, if you hire this specialist, this cost segregation specialist, you can legally pull up those tax benefits and claim them right now. Now, the even cooler thing to kind of put a cherry on top of this is that we still have 1 full year left where we can actually get bonus depreciation. Bonus depreciation is literally, it was defined when Trump was in office last time. Through the Tax Cuts and Jobs Act, they let you basically take depreciation faster. Here's a big gift, tax credits, essentially. I shouldn't call them tax credits because that's not what your CPA will call them. Your CPA will call them a passive loss. If you're taking notes, or if you could type that in the chat for me, I just want to make sure that you speak to your CPA the right way. Type passive loss. So what you do is you invest in a piece of real estate and you're eligible for passive losses because of that. The IRS knows that that piece of real estate, it's got windows, it's got a roof, eventually they're going to wear out. And so they give you these tax incentives each year to be able to use that. So you can use those passive losses right now. Even if you buy into a deal today, tomorrow, December 15th, you can still use it against this year's taxable income. And so that's why this is the busiest month for us all year round. Every single December, people come running to us, trying to place money so that they don't have to give it to the IRS as a tax bill or tax liability. So what I'm doing personally right now is this. I had a meeting with my CPA. I had him start to run all the numbers and everything that I'm involved with. And I asked him to give me basically a forecast. How much am I going to owe the IRS? And he's coming back to me. He promised me, I just got an email update from him from a little bit ago. He promised me that next week he'll have an update for me. And whatever that dollar amount is, let's just say that it's 200,000 in tax liabilities that I owe. I'm going to make sure that I invest the right dollar amount into a multifamily property to offset that tax liability. Because I'd rather put the 200 grand into a multifamily deal and give it to myself than give it to the IRS. If I can get the same benefit, literally, if I can put it into a multifamily property and get cash flow from it, appreciation from it, all the benefits from it, and not have to pay tax, why wouldn't I? And so that's the big encouragement for everybody here is just make sure that you understand these tax rules. Accelerated depreciation. This is one of the biggest gifts that all of us have at our fingertips right now. Instead of paying the IRS, pay yourself with money instead. Steve, let me know how deep I should go on this. And it would also be pretty good. This is impromptu, but we should interview Mr. Lavin for a second on this because he's got a really good purpose behind and how he does it as well.
Yeah, let's we can actually pull Chris up. Give me just 1 second. Well, I got to figure out how to find. There we go. Chris. Here we are. I'll pull myself up. So Chris, talk to us a little bit about how you use your tax benefit.
How do I use my tax benefit? So the whole purpose of me to generate income is for altruistic reasons. One of the things that my wife and I are passionate about is helping the world. And me personally, I reach out and I help children, either children in distress, abused children, children that need help, need food, whatever that looks like, and the people surrounding those children. So one of the things that I was fortunate enough to be gotten through several multi-million-dollar exits, lots of capital gains, big exit this year, lots of capital gains. And one thing that I know for certain, and I am not making a political statement, I don't care who you are, what side of the aisle you fall. One thing that I know for certain is that me as a businessman am better equipped to take my dollars and utilize them better. So one of the things that my wife and I have decided to do as part of how we affect the world is we're involved in real estate, and all of the cash flow out of that real estate goes to those causes. We're feeding children. We're opening food pantries. We've got places we partner with Home Depot to clothe kids throughout Florida. And then what happens next is the tax benefits of these transactions come to me, so that all of those capital gains are being offset by these tax savings, or what it actually is depreciation losses on a K1 that immediately offset any income or capital gains that I might have. So as a result of taking advantage of this stuff, I'm ashamed to say that last year I got a $50,893 refund from the IRS. So even though I made probably more money in the previous 10 years, I still got that refund. And the same thing is going to happen for me this year. So like I said, I'm much better at managing my money. Whatever you choose to do with it is better off in your pocket than the government, because there's rumors that the government has built bridges to nowhere. All of the pork in every transactional thing that happens on the Hill is a reality. So that's what we do with the tax benefits. We literally keep from giving the government more than they're due, and it's operating well within the tax laws. And it makes me sleep better at night.
Thank you, Chris.
I mean, it is really awesome how you are supporting kids. You and your wife are great. That's pretty awesome.
Thank you.
All right, so Nate, if you want to put Sarah back up on the screen for a second. We've gone through this. With, I know Ralph has seen this before. If you have any questions over this is something, it's easy to look at from the top down, but I think when people start to try to implement this, it can get difficult. What is the absolute easiest way for people to implement this? Because a lot of people aren't going to do repair versus replace. They don't have their own rentals yet. But just to take advantage of accelerated depreciation, is it really as simple as just investing with a good syndicator, Nate?
So there's two steps to it. Number one, I'm going to put this little QR code up for everybody. Go ahead and scan this now as I'm talking. This will let you download the book. Okay. We covered one of the four from a high level up. I might get into a second one in a minute. But if you want the details on every step of the way and how to implement it, how to talk to your CPA, then scan this little code on the screen and download the book so that you've got the book. That's our gift to you. Happy early Christmas. Okay. So how do you actually implement it? Well, the document that I had up a minute ago, I'll switch back to the QR code in a second, but this document right here, this is an actual cost segregation study. I actually had a question from an investor 3 or 4 weeks ago. He's someone that has owned a lot of real estate in his life, mostly single family home rentals. And he said, hey, I don't want to waste money on a cost segregation report. I don't think it's worth it. I'm just going to stick to what I'm doing. Why are you spending money on a cost segregation report? We spend roughly about $8,000 on each cost segregation report. And for us on multifamily specifically, like that deal that I just put up there, we'll bring in over $1 million in tax benefits. $1 million. If we wouldn't have had the cost segregation report done, it would have been decent tax savings, but it would have been drug out over 27 and a half years. Imagine being able to take $1 million tax benefits this year versus dragging it out over 27 and a half years. And I could go on and on with case studies like that, but the step is you hire a cost segregation specialist, you do the report, you pay them their $8,000. That's step one. Step two is you give the report to your CPA, and your CPA then acknowledges it and says, you know what, cool, I'll input this into your taxes. For people that partner with us, they don't have to do either. It's really simple. For them, they just invest, we do the rest, and we issue a K1 that already has the cost segregation factored into it. It already has the passive losses figured out. It's already got all the tax benefits right on it. When people come to us, especially this time of year, the first question that we're going to ask is, how much tax liabilities are you trying to wipe out? We have a gentleman right now, Sue's working with this individual. His name is Michael, really good dude. Michael and his wife did really well this year. They cleared the $1 million mark, and they've got quite a bit of income that came in. But Michael knows that he's going to get hammered by the IRS. The IRS is going to want a big piece of that, and he doesn't have a lot of deductions. And so what Sue's reviewing for Michael and his wife are which investment properties could they put money into, and what is the maximum tax benefit that they can get from that. So understand how much you need, and then get with a group that knows the cost segregation study process. And then from there, just let the team do what they do best.
I mean, that really is it. If you're not an active investor, finding a great syndicator that takes care of you will make this all happen for you. And that's part of what we do at Home Invest. Linda asked, on the call with my phone, I screenshot the QR. How do I upload to get the book? If you are on your phone, I think the easiest way, if you put book in the chat, I think, Philip, we can figure out how to get you the book. Are syndications still available? Yes, they are. You can book a call. Sue just put the link in the chat. You can reach out to me or Sue through that link. We'd be happy to talk to you about the deals that we have. We do actually have one special deal that has huge tax benefits that we are offering right now. Nate, I know we weren't going to go through deals on this call specifically, but do you want to bring it up?
How about this? I'll describe from a high level, like what it is. We've got a multifamily property that literally you can get between 50 and 75 cents on the dollar for every dollar invested back as a tax. I can't call it a credit, but a tax incentive, a tax benefit for you. So it's really high for industry standards. Like, it's really, really high. It's the best that I've seen all year for sure. And probably going to be the best that we see this year and next year because of the tax code is changing again at the end of next year. So if you're looking for a very fruitful syndication that has a very good tax benefit, then use the link that Sue put there. It's the one that says homeinvest.com/zonebook. Click on that, choose a time with her, jump on, we chat for 15 minutes, and we'll walk you through all the details of it for sure.
There you go. We can walk you through the syndication. It does have a great tax benefit attached to it. And Philip, if you can put that link just in the general chat, if you guys want to download the Sarah book, Philip is dropping that link. All you have to do is click on it and you'll be able to download the book.
If you're following us online and you don't see any of these links and you're like, hey, what the heck, where's my link? Just put link in the comments, LINK, and our team will private message you with it. LINK in the comments, and our team will private message you with it. Otherwise, you can scan what you see on the screen right now.
All right. So we covered solo 401ks, self-directed IRAs, and we went through the Sarah process, how you can maximize your taxes, your tax refund, I guess would be the easiest way, or accelerated depreciation to offset your taxable income so that you pay less in taxes. Chris, thank you for sharing what you do with your tax savings, as well as, you know, what you got back. This is how high income earners don't pay anything in taxes. They offset it, usually against real estate. I mean, we never saw Trump's tax returns, but I'm pretty sure that he pays very little because he offsets it so much.
We just got to see the cover page, and I did go through it thoroughly, but it was only the cover page. But you know what? Every political candidate, for the most part, has published their tax returns, and there's enough out there to understand and know. That's how I got to read Mitt Romney's. It's how I've read Joe Biden's, Kamala Harris's. Like, I've read a lot of tax returns, and it's no secret. They're using what's available to them. It's totally legal to use this, and you might as well be doing it because your politicians are right now for sure.
Awesome. If anybody has any questions, you can put them in the chat. We're here to answer all of your questions and help you guys be great stewards of what God has given you. Nate, is there anything else that you would like to cover on this call? Anything you think we need to touch on? Sue, Chris?
You got one more from iPhone saying, how does having a number of deductions work when you're trying to take equity out of your investment property? I need a little bit more information to be able to properly answer that. I can try to put my arms around it. If you give me a little more context, that'd help me, iPhone.
Can't you just have them unmute and ask the question?
Yeah, or feel free to do that, iPhone.
Yeah.
Unmute, go
I
ahead,
can
fire
pull them
away.
up.
And minimum investments for us are $100,000. We do accredited investors only, which means you make 200K as an individual or 300K as a married household, or you've got $1 million net worth. And we've got a couple of different opportunities for accredited investors in our deals.
I don't know if iPhone's going to unmute or type more
Steve,
in the chat.
Do you understand the question?
I think he's saying, like, how do the deductions work? If he's trying to take equity out, it depends how you're trying to take equity out. If you're taking equity through a HELOC, how would a tax deduction work? You would still be able to do the cost segregation study. It shouldn't affect anything. At least that's my thought. Nate?
Yeah. Yeah. And if you're doing when you take out debt on any kind of equity, that's a tax-free event. Like, we have a multifamily right now live, 100-unit multifamily. God willing, it closes here in the next week and a half. And that particular multifamily, we're going to own it for a little bit. We'll own it for a year or so. We're going to go to the bank. We're going to refinance it. We're going to pull back our money. And when we pull back our money and put the cash back in our bank account and give our investors back all of their money, that's a tax-free event. There's no tax on any kind of tapping of equity on a refinance. Refinance is technically debt. So there's no tax on that. That's a very powerful play in real estate. I think that is probably what you're asking, but know that there's no tax consequence whatsoever. Cool. Old Goat says, will there be a recording? I believe so, as long as everything processed the way that it's supposed to. We will have.
Yeah, and it's also being shared. It's streamed a couple different places, so you'll be able to access it there.
Cool.
iPhone, you can reach out to us through the link that is in the chat. Please book through that. Sue just dropped the link. You can click there. That makes sure that you are in our system and contacted. We don't just reach out through phone numbers. That would be the suggestion.
Cool. Outside of
All
that,
right.
just be good stewards. There's no reason to overpay the IRS this year. You can pay them their legal amount, but don't give them a tip.
That's it. All right, guys. Thanks for tuning in to this special webinar on tax and self-directed 401ks and IRAs. We will see you on the Opportunity Zone on Tuesdays as always. And if there's ever anything we can do for you, you can reach out through any of our emails. They will eventually get to us, and we'd be happy if we need to jump on a call. Myself, Sue, Doug, any of us would be happy to do that. We're here to serve. Wishing you guys a great holiday season, and we'll see you soon.
Thank you. Bye.